All righty. Good morning, everybody. Seeing some people start to log in, just making sure we got everybody in time. Giving you a couple seconds here. Let me know if you can hear me. All right, let's get started. Welcome everyone to the Hurley Investments Trade Findings and Adjustments of February 23. That's actually wrong, isn't it? March, let me get this correct, 9th. March 9th. Welcome to the March 9th Trade Findings Adjustments. My bad. All right. Forgot to switch that up. What did we talk about on February 23rd? It's been a couple weeks. We went over a couple questions. Why do some stocks that had great earnings not continue up? That happened with particularly Under Armour. Just kind of crapped out. Ford. Not that it really crapped out except for a few weeks ago. I believe that was probably right after earnings, but what else? Disney didn't take off. Great earnings. Didn't get going. Fallen quite significantly since then. So my reasoning for that was simply that after a good run, you can kind of see that good run here at the beginning of the year. And some of them earlier than that go back to even last quarter, November. This was Under Armour again. Nice run up. So one of my reasons, again, a lot of these stocks had already taken off, and looking ahead, the market, it's hard to justify buying into any future catalysts when they don't seem to be there. Particularly now when, and I'll talk about in a minute, is some of the comments from Fed Powell earlier this week that caused this fall down to 4,000 price level for the S&P. Basically saying that Fed's going to have to be still aggressive in raising rates. So another reason why looking forward, it's hard for the market right now to justify buying into some of these, continuing to buy into some of this stuff, some of these stocks. Other reason was they're, profit taking after a bullish quarter, beginning of the year, and so on. So we got that taken care of. This is a question I kind of wanted to go with here, and is still relevant. So what is the next catalyst? My thought then was, hey, we've been slowing down from 75 basis point rate hikes to 50 basis point, and quickly in the next quarter, from back in January, moved to a quarter point rate hike. My thought was, well, if we do get a 0% rate hike and the Fed is happy to kind of sit pat and see how this plays out, which is kind of what they indicated to some degree, that that could be a big catalyst for for the market to head up. Given that Powell just came out and said that, they're still going to have to be aggressive, raising rates, that kind of puts a big, that throws a lot of water on that idea that they're going to come up with a 0% rate hike or whatnot. And at this point, I would be more worried they're going to come up with, go back up to a 50 basis point. Powell's indicated this week that the Fed is still going to have to be aggressive, raising rates since inflation numbers have still gone up. I'll say if, which this is not looking like it's going to happen. But if they hold on to maybe a 1/4 point rate hike this month, that might ease the market's fears of expecting a 50 basis point hike. And who knows what reaction that will give. So my suspicion, oh my gosh, that's how we spell it. My suspicion is that the Fed will go back to a 50 basis point rate hike. So market had hit this bottom on the 200-day as it kind of floated down. I think one of these days was higher inflation numbers that wasn't positive, obviously, for the market. Bounced on a technical bounce here on the 200-day. A lot of our stocks were still going up, and we had started to get protection off. You can see this bounce. Let's look at Baidu. Baidu had another bounce off a technical 50-day, and as soon as it started to come down, and a lot of these other ones, we've been getting protection back on. So this is old news. We had started to take protection off as things started to bounce on technical support levels, and then after Powell's comments, we've started to get protection back on. The hope was that it would, we were going to have at least a run into the next rate hike where we start to get things protected over these this last week and this coming week for mid-March rate hike meeting. And so since it started to fall down after Powell's comments, we started to get protection on sooner than we were hoping to, as we were hoping to let stocks have a bit of a run back up, see where they got to. So that's where they got to, at least for Baidu and a couple of the other ones I just showed. And we're just following what our stocks are telling us. And right now, the market just is not happy with some of those comments from Powell, and we're following that. We're following that precedent. We talked a lot about price and value. I'll let you go over that if you want to go back to that February 23rd trade findings. If you want to hear that stuff again, that is important information. Price and value are not the same thing. Important to remember that. Important to look at your stocks as real companies. That's what they are. It's important to weigh your fundamentals, understand your fundamentals of the stock that you're investing in, the company that you're invested in, over being swung around by what the price is doing. Because if you know what your company's value is, anytime the price takes a dive, it's a discount sell, and you know where you have a good deal to buy the dip. All right, so going along with what I was talking about a minute ago, again, the next catalyst, it all just depends on what happens in this next rate hike. I would think anything lower than a 50 basis point hike would be somewhat positive. And a 50 basis point hike, or of course more, is going to be really negative for the market. Because it seemed like we're kind of starting to get to the top of our rate hike, our interest rate level, and the market was starting to rally on that. I mean, you can see that with Baidu. You can see it with a lot of stuff here, right? Even as jagged as it was for the whole market, right? But that is the barometer I would be using to understand what's going to happen, as in other words, whether there will be a catalyst or not. Right now, it's more of a risk for us. I'll probably say that. More of a risk that we are protecting stocks for, or stocks against. Risk we're protecting stocks against. Any other thoughts from you guys as to what might be a catalyst? I can think of only one, and it's the main one we always talk about. And it's obviously going to have to go against any negative stuff. That is going to come from our next rate hike. What do you guys think? What might be our next catalyst? Seems like one of you had mentioned this last time we were together. And of course, I'm looking for a specific answer, but any other thoughts or ideas that you have are welcome, of course. What is our next catalyst? Exactly. Thanks, Jeff. I knew someone was going to say it. Jim said world unrest. Maybe a catalyst to the downside. Help me understand what you're saying, Jim. Does that mean some opportunity to buy the dip, or what are you getting at there with that comment? But I definitely agree. Earnings could show how good companies have been able to adapt to a higher interest rate environment. And that is one of the reasons why some of our stocks have done so well. Apple has done well through that environment. Meta, believe it or not, has done well through that environment, and any news you see of them firing people is met with an increase in stock price, because that means they're dealing with the issue, less cost that they're trying to get rid of, more focus on their fundamental part of their business, which is, of course, ad revenue, and less focus on the metaverse right now, which the market just does not like. Uh, that Meta has spent so much time and money on that so aggressively. All right, so thanks, Jim. Jim said, so yeah, to the downside could hurt the market, Ukraine, China, Mexico. Yeah, so some of the world unrest certainly won't help as a form of catalyst. The Russia-Ukraine thing, that's kind of old news, even though it's still there. The market gets shocked by new news. We have the drug wars in Mexico, and the 4 Americans that were abducted and 2 of them killed in a border town in Mexico. And yeah, I don't know. I don't know, Jim. As awful as that is, I just don't see our president willing to do anything about it. And frankly, people should just not be going over there for that kind of thing. I think they were going to do a medical procedure. It's just, I think the consequences of them letting the cartels, rule the roost, so to speak. You can see that's why people are so uh, hell bent on getting out of Mexico and coming up to have opportunity and security and rule of law here in the United States. And obviously just a sad situation. Yep, I totally agree, Jim. All right. Those obviously aren't going to help. But I do think the market is much more concerned with our rate hikes, thankfully. Um, there's always going to be world unrest. There's always going to be crazy stuff happening. And yeah, a lot of that is kind of news that's baked into everybody's subconscious. And I guess we'll see what happens on this next rate hike to see if we get something positive or negative. But right now we're looking at protecting our stocks. We've got pretty much everything protected. Again, we have Google and Visa that don't have puts on, that have covered call positions on. So let's look at Google. Just some people of ours had Google. It's not a main stock of ours, but few people wanted it. And I believe we have 100 strike covered calls. That's helping out a bit. I think we got them on at a pretty good time, so these things are kind of holding up. Let's see, Visa. Visa was up at 235, I think. It's just has not been able to get up. It was either 230 or 235. I can't remember off the top of my head. I have to go back and look, but obviously the stock is struggling to get over that point, so that looked like a good call on our part to have a little bit of protection, get paid some credit premium on selling covered calls for the shares we have. And it's another one where if it does pop up and take off, we're okay letting it go at 230 or 235, whichever that was. Right now it's looking pretty good. Maybe we'll have a chance to keep rolling those out for more credit. But as of right now, we do have that little bit of protection on those ones because they've just kind of been going sideways. And that seemed kind of prudent to give us a little bit back. And we'll look to get those protected as well in a full collar trade, which you guys know is covered calls and protective puts with the stock ownership as a ultimate protective trade. So that's really it. We have Disney puts are so far in the money. I think we have 109s that today we were making up every dollar of the way down on Disney puts, which is really nice to have that. We're in that that point where we can just kind of let it work. Unfortunately, those expire, I think, Friday, so we're going to have to be rolling those down. But we'll have been able to take a nice profit on those puts, which is always what we're striving to do. And then going further out in time on probably 100 strike. If we can get a 98 or a 99, usually they go in $5 increments after 100. So we'll see. But we'll roll those out for more time around 100 strike and keep Disney protected for our upcoming rate hike. Baidu was down bigger today and breaking a 50-day. I think we have 140 puts on, and those are closer to the money where they're not making up every dollar of the way down, but they're they're catching up. And so if you guys are seeing some of those in your accounts and wondering why, hey, why we're protected in BID, why is the puts not making up enough? It's really just that usually at the end of the day they start to catch up a little more, and the prices of those options start to catch up with where the stock is at. And obviously, the further down the stock goes over the coming days, the more and more those puts as a percentage is going to make up dollar for dollar on the way down. That's just how it works. So glad we've got those on, glad we've got protection on, and kind of interesting that we did have the market up earlier, pretty flat right now. It's trying to hold on to that 50-day. So as far as the trade goes, I would just be keeping an eye on the S&P. And if we break that 39.42-ish level, I guess I have it at 39.41. If we break that 200-day again to the downside, I'd be adding SPY puts on. That would be my kind of line in the sand. But as far as any other kind of trade, it's really, again, because of the reasons we've set up here, there's really not a direction that I feel comfortable picking. If you feel like you have you need to give yourself some protection that you don't have on your entire portfolio, I'd be looking at SPY puts sooner than later, and maybe not waiting till it gets that down below that level, the 200-day moving average, just to give yourself some portfolio protection through the upcoming rate hike. If you're looking more protection, if you're looking more for a trade to make money, I'd be waiting till that falls below that point. So those would be my suggestions. What questions do you guys have for me before we call it a day here? Thanks, Jim. Take care. All right, guys, I'm not seeing any questions, so I assume we're taken care of. Thanks for joining me this morning, and yes, it was wonderful to be back. Where was I? I'll just say I was trying to help out our Disney stock by taking some kids to Disneyland, and I'll leave it at that. Thanks for joining me. We'll talk to you guys next time. Take care.